Before we dive into episode 1, let me take you back to where this all started. And I want to do it with a question. You have probably heard the saying, a fish doesn't know it's in water. Now, that was the whole point of our introduction. SMEs are swimming in valuation challenges every single day: succession, disputes, fundraising. But because professional valuation has always been expensive and opaque, most of them have never stopped to ask, what is my business actually worth? Now, in the intro, we use a navigation metaphor that I want to briefly revisit. Traditional valuation was like navigating a compass. You needed expensive data subscriptions, proprietary formulas, and specialists just to get a rough direction. It works, but it was slow, costly, and out of reach for most SMEs. The shift we are making is from that compass to a GPS. The data explosion, SGX filings, MES publications, Yahoo Finance, government databases, has handed us coordinates that were once locked behind paywalls. The raw material for a credible valuation is now freely available. What was missing was the framework to use it. That's what this series is built around. Every valuation has waypoint, gathering inputs, making adjustment, applying the right methods, reconciling the outputs, and producing a report. Follow those milestones in order and the destination. A credible, defensible valuation takes care of itself. In episode 1, okay, why valuation became expensive and opaque. We look at the problem from ground up. What SME actually need, why CPAs are the natural solution, and the three core valuation approaches. In episode 2, building a defensible toolkits from free data, hands-on with SGX filing, Yahoo Finance data, and MES data. Now we will show how to triangulate these sources into a model that holds up under scrutiny, including real case example from REITs, rights issues, and SME placement. And in episode 3, it's about applying the framework to a real SME case. Now, theory into practice. We take an actual business scenario, run through all three valuation methods, and produce a reconcile range. The kind of output you could walk into a boardroom with. Our mission across this entire series is straightforward: free data, clear frameworks, and real confidence. For SMEs owner who deserve to know what their business is worth, and for the CPAs who are ready to offer that service. So let's get into episode 1. The question why we are answering today is, why does valuation matters, and how do you actually approach it? Now, if you run a small business and you have ever needed to know what it's worth, maybe a partner wanted out, maybe a bank asked for a valuation report, you have probably been told it will cost you tens of thousands of dollars. Today, we are going to change that. Now, SME constantly face situations that demand a credible valuation: succession planning, shareholder disputes, raising capitals. But the Big Four's fees put professional valuations out of reach for most business owners. Here's Here's the underutilized opportunity. CPAs are already trusted advisors to these same businesses. Valuation is a natural value-added extension of the work they are already doing. Not a leap, but a step. The good news is that credible data is freely available. SGX filings, Yahoo Finance, MAS publication. You don't need a Bloomberg terminal to do this properly. The goal of this series walk you through how to produce affordable, transparent, and defensible valuation that actually help SME owner make better decisions. Now, before we talk about how to value a business, let's make sure we are clear on why. The purpose shapes the method, and getting this wrong leads to a report that doesn't hold up when it matters most. Now, in transaction, M&A deals, buy-sell agreements, and succession transfer all need a reference point that both sides can stand behind. Without one, negotiation stall or go sideways. For financing, bank wants to know what security is worth. Equity investor want to know what they are buying into. Even grant applications sometimes require you to demonstrate enterprise value. Now, disputes, shareholder oppression claims, divorce proceedings, IRAS tax challenges. In all these cases, you need a number that can withstand legal scrutiny. A back of envelope figure won't do. Strategic planning. This one is underrated. A regular internal valuation helps owner track whether the business is actually building value and where capital should be deployed next. Key takeaway, the purpose of the valuation determines the standard of value you apply. Fair market value, fair value, investment value. And that flows into every assumption you make. Always clarify the purpose before you start. Now let's get into three main valuation approaches. Think of this as lenses. Each one looks at the business from a different angle, and together they give you a much clearer picture. Income approach, DCF, you are projecting future cash flow and discounting them to today's value. Very powerful for growth businesses. The catch is a highly sensitive to your assumptions on growth rate and discount rate. Small changes compound quickly. So you need to be disciplined and transparent about your inputs. Now the market approach, you look at the comparable listed companies or recent transactions and derive a multiple. Typically EV over EBITDA or EV over revenue. This is grounded in real market evidence, which makes it easier to defend. For Singapore SMEs, SGX listed peers are a solid starting point. Now the asset approach. You adjust the balance sheets to reflect fair value of assets and liability. Most relevant for holding companies, property heavy businesses, or where earning based method breaks down, like a business running at a loss. Triangulation, no single method is the whole truth. In practice, you run two or three approaches, then reconcile them into a valuation range, say 11.5 million to 12 million, and explain why the method converge or diverge. That process of reconciliation is what makes a valuation credible and defensible. That is the foundation, the problem we are solving, why valuation matters, and the three framework you will be using. So in the next few slides of episode 1, we'll go hands-on with the understanding of risk and return, the valuation process, and normalization adjustment. Now don't forget to subscribe so that you don't miss it. And if you found this useful, please hit the like button, share it, and leave your comment below. Your feedback helps shape this movement and keeps the conversation going. Thank you.